White Claw, 5% alcohol. I might get drunk off of this. I'm kind of a lightweight. Yo, my name is Sebastian Salvetla. So whenever I go online, because I follow a lot of people and channels that talk about money, a lot of the focus could be about investing. So how to invest, where to invest, and what to invest in. I mean, don't get me wrong, I believe everyone should start thinking about their future and where they want to be financially, whether that's 10 years from now or at retirement age. And not just because you want to have a lot of money, but because of the freedom and choices money could give you. Having a plan and starting to invest as soon as you can will help you get there. But you don't want to start investing or preparing for the future without being prepared for more immediate situations. So like I said in my last video, you don't want to start investing before you have a solid financial foundation first. So other than having a rainy day fund or an emergency fund, another part of that foundation is getting rid of high interest debt, which is what I'm going to talk about in this video. A study done by NerdWallet at the end of last year found that the average total debt in a U.S. household was $137,879. And that includes everything from credit cards, mortgages, car loans, student loans, and any other household debt. Of course, all debt is not created equal, and I'm sure you've heard that there's good debt and there's bad debt, but that's an argument I'll leave for another time. The argument I'll address is if you should invest and pay off debt at the same time, or if you should pay off debt first and then invest. I don't think the answer is straightforward because we're all different and we're in different situations. I think the answer depends on many different factors like your goals, your age, how much you have in debt, or what type of debt that you have. How much interest you're paying on those debt, how much you care or how much you know about investing, and even the emotional toll the debt might have on you. An argument I sometimes hear is that you should invest if the return that you get from an investment is more than the interest that you're paying on the debt. I mean, that makes sense, right? So if you were to invest in the stock market that had an average return of 10% over X amount of years, and you have student loans that charge 6% interest, that you make is 4% spread. The problem with that is that the stock market is incredibly volatile and that 10% is not guaranteed. So for example, the S&P 500 has been in the red the past year and who knows how long that's gonna last. But on the other hand, that 6% that you're paying on the student loans is guaranteed. So if you were to pay those off, then you'd be instantly guaranteed to make 6% by keeping that money. Now that sounds like I'm saying that you should pay off all debt first, but not really. So I consider anything that's charging over 6% interest high interest, and I strongly believe that you should pay those off first. The most common debt that people struggle with is credit card debt. It's easy to get and it costs a lot. According to the Federal Reserve Bank of St. Louis, as of August 2019, the average APR on credit card accounts accruing interest was 16.97%, and the average balance was $6,849. At that rate, you pay about $1,162 in interest in a year. Many people just pay the minimum payment due each month and don't understand how that debt can build up over time. Also, if you want to invest while you have credit card debt, you might not realize that the interest that you're paying on that debt is probably more than whatever returns that you could get from the money you invest, even on a good year. For example, say you had that average of $6,849 in credit card debt, paying $1,162 at that 16.97% APR. And say you had $300 available to invest in the stock market every month, which is a total of $3,600 for the year. Now, even in a good year like last year, which saw the S&P 500 grow close to 30%, the value of your money would have increased close to or just over $1,000. That's still less than the interest that you'd be paying on those cards. What if the market only grows 10%? Or what if the market goes down and stays down all year? If you're trying to build financial stability, your safest bet is to pay off those high interest debt first, which is a guaranteed return that you'll have in your pockets. And if you're going to continue using credit cards, I'd recommend you only use it if you know you're going to pay it off in full every month. Now, what if the interest is less than 6%, like it usually is for car loans or student loans? Now, if you listen to Dave Ramsey, he'd probably tell you to pay off the debt. I think that's good advice, but in my opinion, it also depends on all these other factors. Take your age, for example. If you're in your 20s or early 30s and you have student loans paying 3.5% interest, should you spend the next 3 to 5 years focusing on paying off that debt? I mean, that would be a good decision, and there's nothing like being debt free. But if the debt doesn't stress you out and you could comfortably pay more than your minimum, which you should, then I wouldn't go that route. Because you have time on your side, if you also invest, those extra 3 to 5 years could make a big difference in how much money you have available in retirement if those investments are being compounded for 20 to 30 years. You also get a better feel for what investing is like sooner, and you'll be better prepared for when you pay off those debt and have more money available to invest. Now, when it comes to mortgage debt, I think it depends on your goals. So if all you want is to own a home free and clear, then you should aggressively pay it down. But if you're an investor and you understand the risks and your risk tolerance, then you could leverage your debt and use any extra capital to grow a bigger financial portfolio. I'm not a financial advisor, and this is not me telling you what to do with your money. In the end, we're all different and have different circumstances. But with that being said, if you want to reach financial stability or even financial freedom, then it's important you understand the different strategies and the steps you could take to get there. And you need to start with a strong financial foundation by having an emergency fund, by getting rid of any debt that keeps you from getting ahead, by educating yourself, and by taking action. It's easy to get excited about investment opportunities that you might hear about, but you should always consider all the different factors and what will most benefit you long term. So that's all I got for today. If you think this video was helpful, make sure you like it and subscribe if you haven't already. And don't forget to share this video with a family or friend you think might be interested in this type of content. Thank you guys so much for watching, and I'll see you next time. Peace!